Welcome to Chit Chat Money. This is our Thursday deep dive episode where we interview an analyst on a single stock or industry. And today we're talking with Anirban Mahanti about a little known company called Apple. Anirban is a lead advisor at Seven Investing. And this show, everyone already knows what Apple does generally. I'm sure they're familiar with the brand, but Anirban has owned the stock for, I believe, a little more than a decade now. And I think going through the company in the eyes of Anirban really illustrates how well the buy right and sit tight approach can perform for investors. And this is a perfect example of it. He's owned this thing for 10 years. It's been a wonderful investment for him. And a lot of his reasoning and rationale in the early days was behind those qualitative assumptions, how he assessed the business in the real world. And I think it's just a really fun example. And he goes through the business in great detail, talks about the investment as he sees it today. But before we get to that, we do want to say Seven Investing is a friend of the show. They come on the show all the time. You've probably heard a number of interviews that we've done. Anirban, like I said, is a lead advisor for them. And if you're interested in checking out any of their write-ups, they have a huge catalog of research now. I really do recommend going and checking it out. We use it all the time for kind of idea generation and exploring new companies to look at. That you can get $100 off right now using the code CCM. And I believe we'll have a link in the show notes as well. So if you want to go direct through the link, go ahead, check it out. But that's CCM is the promo code. You get $100 off the annual pass for Seven Investing. So like I said, go check it out. But without further ado, here's our interview with Anirban Mahanti.
Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schafer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are also general partners at Arch Capital, and Arch Capital may have positions in the securities discussed in this podcast. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guests is not formal advice or recommendation. Now please enjoy this episode.
Okay, welcome in. Today we are joined by Anirban Mahanti. I want to say like third time guest at this point. He's been on the show a number of times. He's a lead advisor at Seven Investing. We will link to Seven Investing's website in the show notes. So go ahead, check him out. He has a lot of recommendations that you can peruse if you enjoy this episode. But we're talking about a company, a little known company called Apple. I think are they the biggest company in the world right now? They are. Okay. So yeah, I think most people know them, but Anirban, you have been an investor for quite a long time, if I'm not mistaken. So I guess, why don't you take us through that? When did you first start investing in Apple? And do you remember what your initial thesis was?
Yeah, it's a great question. I've not been an investor for as long as I would hope I was. So my first, I think, purchase was late 2012. So it's still a little over a decade. And I was just, because we're going to talk about this, I was just checking that, cost basis. So my cost basis around those, from the buys that I made, 2012 and early 2013, they would range between say $15 and $20, right? So, somewhere between a 10 bagger and an 8 bagger or 10 bagger in this time for a company which was pretty large at that time. I thought, which I think is pretty fabulous. Just speaks to sort of the, one of the benefits of, just buy and hold, right? You just need time to do its thing, and good companies, given time, can, really deliver the goods. Why did I buy it? Well, I used to work at a place called NICTA as a research scientist at that time, and there was a lot of buzz about Apple products. I had a colleague there who used to buy every new Apple product the moment it came out. Of course, I was an iPhone user. I had an iPhone since 2009. So, the fabulous experience, being a Mac user since 2008, 2009. So, have experience with their products, and I love their products. And, there's just the enthusiasm of the people lining up and to buy the product. The product is coming out, the excitement that comes with the product. the sort of the leadership provided by Steve Jobs. Those were all the reasons. Like, I didn't look at financials at that time when I bought the stock. I didn't think, oh, is the PE reasonable or is the valuation reasonable? I said, look, I just thought this company makes fabulous products. The people who buy these products, or use these products, love buying them again and again. They have a fanatical following. The stuff is like incredibly well made. Even the packaging, the joy opening the packaging, all of those, it was all the qualitative aspects driving it, right? And my wife at that time had a Samsung phone. And we purposefully had one Samsung and one Apple, largely just to experience the two different things. And she said, I like your stuff more. Why do I have this? So, the next cycle of upgrades, she moved on to having an Apple phone. And then there's always been a question of who has the latest version, because we unlike some really fervent fans who upgrade every, every, I would say, year, we sort of upgrade every 2 years. So,
that's still a pretty regular cadence. And I think, if I'm not mistaken, it looks like you've got the Apple AirPod Maxes on the headphones.
Yes, I do. Yeah, well, we have a lot of Apple gear in this house. The AirPods and the Max AirPods and the HomePods, and this household runs on Apple. If some of this stuff doesn't work, it'll be a problem.
I'm quite the Apple user myself. Brett is an Android user, correct?
Yeah, that is correct. Although I do have an iPad, although I did get that one for free. But yeah, I get complaints all the time. People tell me, what am I switching? Which I'm a little bit stubborn about it, but that is a fantastic, positive investment indicator.
It is funny that, or go ahead.
Go ahead, please. No, I was just going to say that one of the things I used to do in all my previous roles that I've had is that, when I used to work for the Motley Fool at one point, I used to be a very big Apple proponent. I can take credit for converting a number of people from Windows to Macs and, Androids to Apple. We have a small business that we run, and one of the things I look at, hey, are you familiar with Apple tools? Because all our business runs on Apple. So recently, one of the ladies who worked there, she moved from an Android to the latest Apple phone. So the Apple fans do that. They sort of push people to move. That's what Tim Cook calls the switchers.
Yeah, it seems like their customers are sometimes their best salesmen. Let's talk through the business, though. Obviously, a lot of moving parts here. So, you just mentioned all the different product lines they have. What drives the business today? What do you see as the important revenue generators?
Yeah, so at a high level, see, Apple is a hardware and a software business, right? Now, or I should say hardware and a services business. The hardware line, the best way to think about Apple is to go to Apple's webpage and you can see what stuff they have lined up there. And that's basically the main revenue generators for them. It's pretty transparent. So, iPhone happens to be their biggest revenue generator. They have, of course, the iPad, they've got the Mac line, and then they've got they bundle a bunch of things, which they call the home and wearables and accessories business. Now, over time, I guess one of the main things that has happened is previously Apple was mostly in hardware business. And majority of revenues, at one point, maybe 60-65% of revenues were coming from the iPhone, right? And that was back in, say 2016, 2017, one of the big issues with people was, or investors happened to be, well, if the iPhone upgrade cycle slows down, this company is going to be really hurt because that's its bread and butter. And, people were, their upgrade cycles were elongating and things like that. But at the same time, Apple was working on what I'd call the services business, which is things like, iCloud subscriptions, Apple TV Plus, Apple Music, Apple Fitness, all the various services that can Apple Care, which is basically providing extended warranties and things like that. And it's built that over time. So today, the business sort of looks like roughly, I'd say 55% of the revenues 55% come from iPhone, right? About close to 20% of revenue today is coming from services, right? Which is very interesting because this business did not really exist. Let's say if we go back 5-6 years, it was a really small component. And the rest of the stuff is, between the Mac and the wearables and so on. What I think though is interesting is if you look at, the product revenue distribution, I think this is what is interesting is that, if I ask people, what do you think is the second biggest line after the iPhone, right? And that happens to be actually services, right? So services is almost getting close to an $80 billion run rate today. And it probably would hit 100 billion maybe in a couple of years, right? Think of this from the point of view of a company which has a trailing revenue of about, say, 380, 390 billion. That's a lot coming from services. And services has already moved to number 2 position. What I think is it'll be hard for people to think of what's number 3, right? And number 3 it's a far number 3 in the sense that, the gap between the two, the gap, as much as there's a gap between 1 and 2, there's a gap between 2 and 3. And the third position today is held by the wearables and home and accessories. That speaks volumes to Apple's success in, say, for example, the Apple Watch and the AirPods, the smaller ones, not the big ones, right? So those have been really popular, and the accessories business and the wearables business has really done really well. Again, this business has grown from pretty much nothing, right? It used to be a really small business. There were no AirPods at Steve Jobs' times. There was no Apple Watch at Steve Jobs' time. Beats was a relatively, was a Tim Cook acquisition, right? So I think that's how the business is. It's basically selling hardware to people and then getting people into the ecosystem, getting them to then sort of subscribe to different services, right? And you have different tiers of services that you can buy today. Like I'm whatever is the highest Apple One plus tier, because we have the terabytes of storage and we have pretty much every Apple service. So we just have the Apple One business thing. And I didn't even talk about anything like the other ancillary things that they're doing in services, which is like, Apple Pay, Apple, buy now, pay later, Apple savings account, and all the financial fintech stuff that they've been doing.
Now, you talked about how investors were worried about the, let's call it the cyclicality risk of iPhone or the iPhone segment. Do you think that's totally gone now? And if so, why? Like, how did they solve that potential issue that, plagues a lot of hardware makers?
Yeah, so I think, so the answer is yes and no, which is just like, it's a funny way to answer things, right? Because I think the cyclicality is there. It was always there. But I think that at the same time, I don't think the cyclicality is that big a deal, right? And I'll explain it. So let's go back to 2016, 2017, around that time when Apple's PE was like, price to earnings was really low because they were thinking of this like as a hardware maker, how many iPhones were out there at that time? Probably 500 million iPhones were out there. Today, probably 1 billion billion plus iPhones are out there, right? Now, the way I think about this is, I just think, you can think of it as a cyclicality, or I think of it just as a recurring revenue model, right? Because Apple as a company is actually making sure that its products run as long as they can potentially run. So they're, giving you up, they provide you software updates for as long as they potentially can for a hardware device, right? Make them better, make them more useful. They would provide warranty coverage for it. So they want you to use it for a long time. But if you've got, let's say, 1 billion iPhones out there, and even if you assume that 4 years is sort of the lifespan of these devices, then, you're still looking at 250 million odd, replacement phones each year on average, right? And some years it's going to be more because there's been maybe an exciting feature that has come out that people want. Some years less because maybe the economic climate is not that good. But that recurring revenue business that's the thing with these type of hardwares is that, they don't have infinite lifespan, right? However good it gets, maybe 5 years people are going to push it to. But there is a recurring model for these phones, right? And then the mix will change a little bit. And then, if you factor in things like Apple's push into countries, emerging economies, that's been a huge push lately. And they've been trying this for a long time. But it's only starting, I think, to take effect now. Whereas let's push into, say, India or Vietnam. Those countries are growing at a really fast pace. And I can tell you honestly, Android has a huge vast user base. But if you talk to a upper middle class Indian person, for example, they would love to have an Apple iPhone.
The brand is still strong, right?
The brand is strong. Yeah. Exactly. They want it. The only reason they don't have it probably is the cost or whatever. But, if they can convince people that you can get this phone and you can stick to it for 5 years, there will be a lot of switchers coming. So I think the story about the switchers is not done. And I think Apple's share is likely to increase over time than decrease because the brand is that powerful. And this is one of the things that they've done is they have very cleverly cultivated the brand, right? Whether it's about privacy, whether it's about security, whether it's about ensuring that everything stays on your device, whether making the device better and intuitive to use. It's all about Apple cares about you. We charge you and we care about you. You are our customers. Your data, what you're doing is not what we're interested in. We are interested in helping you, right? And that's the messaging that they have used. And that's really, I think it's working, right? If you look at the year-over-year growth rates in those countries, then it makes sense.
Yeah, I mean, I think Apple, a lot of the times they have the best product in their category, right? But sometimes there might be a better one technologically that goes out there. Whenever I have a conversation with someone about, say, a new tablet or a new watch or whatever, they always immediately think that the Apple product is the best, even though, most of the time it is. Even if it's not at that point, they still have that brand perception that it is the best.
Yes. Yeah. Absolutely. Yeah. So the brand is a huge deal and the brand means something. Opening, for example, those retail stores, and Tim Cook was there in India. The reason to do that was, and you could see the lines that we have seen here in Sydney. People, in the past used to see these lines because now everybody buys stuff online. Those lines are incredible. That just shows how much people care about this brand and how much people want this brand. So I think they've got an incredible brand. They cultivate it very nicely. They care for their customers. Customer service has always been A-rated. Like, if you go to their store for a service, you are going to get the service. They never try to sell you something. You see that, Microsoft had stores, nobody was there. Apple had stores just next door, everybody was there. It's just, I think when it comes to consumers and understanding consumers, they do a great job. So that's their superpower in many ways.
Yeah, 100%. I think there's like a million rabbit holes we could go down here with Apple because there's so many different segments to their business. But I wanted to touch on the services side of things. For anyone that doesn't follow Apple closely, and I know they aren't entirely open about it, if I remember correctly, but what makes up the majority of that services revenue?
Yeah, so that's an interesting question, and it's hard to know because they don't really give us the breakdown, right? But I would assume that and the only way I guess I try to read into this is if you read a 10K, which is the annual report, and if the ordering of certain things are provided in a certain order and they're not alphabetic, that's probably indicative of something, right? And so I think App Store revenue is up there. TAC, which is for traffic acquisition costs that other companies pay to Apple. So this would be like people like Google, for example. They would be up there. I would think iCloud would be up there. Sort of then Apple Music, and then maybe Apple Fitness, and then probably some of the other things, right? I think financial services, like Apple's fintech services, have been actually they're growing really quickly, but I think they're from a revenue generation point of view, they're relatively small. Well, what is small for Apple is really big for other people, but it's small for Apple, right? So I would think that Apple's, Apple Pay and all the other related services actually are small contributors to the total revenue. But, my guess would be it's the App Store probably, and the iCloud. Those are the biggest contributors, and maybe potentially followed by Apple Care, and then Apple Music and things like that. But I think the other thing to think about though is that some of those businesses have higher margin relative to others, right? So if the fintech services probably are very high margin, iCloud probably is high margin, but things like Apple Music, for example, may not be high margin because there's a lot of revenue that there are a lot of cost of goods that they have to pay back to the the record labels and the artists and things like that. So there's that aspect to consider. But yeah, I would say those are, but I think the way I think about this though is, and we can come to this later. We can ask the question, and I've been thinking about this a little bit. You can ask it, why did Apple provide services, right? And one of them is, yes, they can provide a better alternative or an alternative that suits their customers, right? But I think the other reason could be that Apple wanted a platform of services, owned services that could help the company actually build or innovate the next computing platform, right? So if we talk about Vision Pro later on, then I think there is a link here. That this is a company that is an incredibly long-term thinker. So if you think about you want to change experiences, then the best way to and you can't always depend on developers and other people coming online because they've seen this doesn't really work very well, right? So Netflix, for example, does not allow a lot of integration with Apple TV. It has reduced its integration. It has made things like payment via the Apple Store harder. Or if you've been paying for it in the past, then it's okay, but you can't no longer do that, right? So the frictions. So one way, if you want to completely innovate in computing experience, then you actually need to own services because then you can show people this is how things should be, and then other people will follow. So I think that's what I think there is a story behind services, and that's largely around these two sort of new areas. One is wearables. Oh, it's mostly around wearables if you think about it, but it's really wearables around glasses and wearables around the wrist. So it's really health and entertainment and other experiences in computing that can change. So I think the services are really a driver for that.
Okay, I have, I guess, kind of a two-part question here. So first of all, I think maybe one misconception, especially in the US, is that Apple is the dominant mobile operating system globally, because it is here in the US. But if I'm not mistaken, I think Android has around 70% of the global smartphone operating system market. So I guess, how far do you think Apple can kind of carve into that? Are they having success abroad in different places? I know you called out a couple of other geographies, but maybe how much headroom do you think they can make there? And then the other question is, what segment of Apple specifically do you think will be growing the fastest over the next kind of 5 to 10 years?
Yeah, great question. So I think, like if this, I don't have the exact numbers, but I think it's probably like something like 70-30, Android 70, or maybe even 80-20 could be Android has 80%. Because in countries like, for example, India and Vietnam, the number of Android users is 8, in just sheer volume is high. And then the percentage is like 95%, right? Everybody has an Android or a feature phone basically that runs on Android. So I think there's an opportunity for Apple to creep that number up over time. Now, I think it would never get close to what it is in the US. In US, I think it's like, Apple is like 40% or something like that, or 45%. I don't think it'll get there, but potentially could get to as high as 20% in many of those emerging markets, right? Which would then tip the balance over to some extent. So, I mean, and every, if it goes from 80-20 to 70-30, that's actually a big deal. That'll happen over time. But I think, I think that there's a good potential for that happening. Like places like India, for example, could have 20%, 25% iPhone penetration, or iOS penetration, given how the ecosystem really works. And many other countries like Vietnam and so on could be the case. So I think that's definitely in terms of like revenue growth, I sort of look at, it's really hard because, again, Apple is secretive, doesn't really tell us what's in the pipeline. But I really feel like services have a lot of legs, and they haven't really pulled all the levers, and then many ways to look at services. But, if you have good services, people want, because the services are linked to devices, people want to buy your devices. If people buy your devices and you have good services, then they're going to subscribe to those things. It's a little bit of this loop that they've got going. But, for example, they could do an ad. Like, I personally feel like Apple TV Plus has some of the best programs available, really nicely curated. But they're expensive for people for the small catalog. But they could, for example, run an ad tier. Right? If Netflix can run an ad tier, why not run an ad tier? Or maybe make an ad tier available, for example, in India for a very low subscription cost, right? And that could work. So I think services are likely to grow, have the fastest growth rate for the business, because especially as sort of their hardware array expands, services should expand, whether it is in entertainment, whether it's in finance, whether it's in health. Like health is another, like Tim Cook was on record saying that health is going to be the biggest impact that Apple's going to have, right? And we haven't really seen anything substantive in terms of health services out there from Apple. We have seen a lot of health devices, AFib and, the heart rate stuff and all of that stuff, the ECG that they're doing, or VO2 max. Those are all health related things that they're doing, but they haven't really leveraged that opportunity yet. Right. So I think I really think services is going to be the growth engine.
Yeah, and with that health stuff, it seems like there's a lot of runway to reinvest into new products. I want to talk about something that also may have a long runway for reinvestment, and is something I think a lot of listeners are either excited about or is on the top of their mind, and it's the Vision Pro. It is the new mixed reality device. Just for any context for the listeners, it's the one they're releasing in early 2024. It's going to cost $3,500 and seems to have some big time technological breakthroughs. So I want to just keep this as an open-ended question. Anirban, as someone who's followed this company for a long time, what are your thoughts as an investor on the Vision Pro?
My number one thought, that's not even as an investor, is that how soon can I get my hands on this device? So I'm going to be up there clicking to get the device as soon as made available in Australia, which unfortunately is not among the launch countries, right? So usually Australia is among the launch countries, but this time it is not. I'm very excited about this. I'm very excited because the tech, as you just mentioned, the tech breakthroughs that they have introduced here is just mind-boggling. So, for example, the new input model, where you have these very fine gestures that you're making with your fingertips, and they're not like placed here; they're placed like on your lap, and it's able to detect that with no delays and work like in a buttery smooth way. That is just phenomenal. Like there's nothing like that.
With no controllers, right?
With no controllers, exactly. Yeah. With no controllers. So you're using your eye and your hand. Now, I'm sure other people are going to copy it, but I don't think something like this exists in even the top research labs today. So this is a phenomenal, I think just shows the depth of the vision work, the artificial intelligence work, and their semiconductor work. The depth of that knowledge is in full display here. Like, this is the other thing I guess I forgot to mention, is that Apple as a company, we think of Apple as a hardware device company, but if you have to ask which is the largest chip maker in the world, the answer would be Apple. Right? Because they design their chips. They're potentially the best chip designers, right? And I like to say, people think about NVIDIA. So if Apple wanted to kill NVIDIA's business, they just needed to decide that they want to, and they could, because they have the skill set in the house. Now they might, like every business decides, okay, I'm going to only do this because this works for me. So they're probably not going to get into selling GPUs, but they probably have the best GPUs if they wanted to. So I think the full display of Apple's capabilities across the tech stack, whether it is hardware, software, assembly language, machine learning, semiconductors in display with Vision Pro, which I think was really, really astounding in terms of the amount of work that they've put into it. So, in my mind, the Vision Pro came across as a device that is being positioned as a replacement, or at least as a very nice companion to your Mac. So, because you could actually do work on it, and it's a standalone computer, right? So if you think about it as a standalone computer with a screen that is like 2 4K TVs sitting near your eyes, that gives you all this perception of depth and width and things like that, an immersive experience, then the $3,500 price point doesn't look like, it has the top end processor that a Mac would have, right? An M2 or whatever it has, M2 Ultra, I'm not sure exactly. But so I think it looks like it's a work companion device, along with an entertainment device, along with potentially a gaming device, right? So that's how it has been positioned. Yes, I think the technology there is, in terms of the input New input model is very exciting. The experience of augmented reality, the immersion experience, I think is again, I think one of the biggest disadvantages this product has is that you can't really demo it the way you can demo other things, because you have to experience to actually. I think that's the biggest drawback you've got in terms of getting sales is you can't get the 3D effects and the immersion effects unless you're actually a user, right? But anyone who has actually tried it on is just going, okay, this is like, it was a aha moment for them, right? And there's an array of reviewers who have tried it, and they're just saying, okay, this is something that you have to use to experience to understand the step change. But I think, yeah, so they're basically reinventing computing in a way here with spatial computing. And it's going to be really exciting. But I think it's more of a Mac and a Apple TV sort of thing replacement, or adjacent to that sort of device that this is being positioned in. Wouldn't surprise me if, in 10 years, a lot of people have these things and they'll become much sleeker over time, wearing them and moving around. Right now, it seems like a far-fetched that, people are going to do that. But when I go to do my school pickup for my daughter, and I see all these children coming out from school, they do have an iPhone, they have an AirPod, and they're just walking like this. And the teachers are telling them, oh, watch the traffic, right? So in a way, people are already wearing something. The stuff that they're wearing is the iPhone. Why not just put the iPhone on your, it's actually safer that way because you actually have the environment in front of it, because the environment doesn't vanish, right? So that's the key thing here. And you can see the environment. How much of the environment you want to see is decided by you and also by the environment. I guess if people come close to you, then you can see them for sure.
We were talking before the show, or before we hit record, that a lot of people doubt Apple's AI and machine learning capabilities. Do you think why do you think that's, why do you think they're wrong to doubt it? And do you think the Vision Pro is maybe one of the biggest examples to demonstrate that they have that power?
Yeah, so I think part of it is just so right now, every tech company is an AI company, right? So we can go and read conference transcripts, and basically we'll see how many times the word AI has been uttered. And, all executives are being pushed to utter the word AI. So it was 70 times that, Sundar Pichai said it, because Microsoft, Satya Nadella said it, maybe more. So he's now forced to say it. So there's a subtle rub that Tim Cook applies in all of this, is that the entire WWDC, and they probably didn't utter the word AI even once, right? And I think part of this is a way of telling the community that, look, it's maybe nice and fascinating for analysts and other people who are analyzing companies to know you're doing this AI stuff and it's going to be all mind-boggling, right? Consumer actually doesn't care, right? Because the consumer really cares about, I have certain things that I want to do. Can you make that happen for me? Or can you give me an experience that I didn't have that I really want to have? They don't need to know whether it's AI or some voodoo or some magic, right? They just need that experience. And I think what Apple has always focused on is that you have to deliver the experience and you have to deliver the product that people want, not a buzzword. So I think that's one thing. So the other thing that happens with Apple, which is different from other companies, is I remember a few years back, there was a Alphabet demo that was done, which was very interesting, which was you made a call and the call went to an AI, and then it spoke with you and it made, for example, a reservation at a restaurant for you, right? There was a very cool demo, but where's the product? There's been a couple of years. There has been no product, right? So a lot of companies have these demos that they do because the wind is blowing in a certain way. Apple never does that because, they just keep those things hidden. But as we just saw with Vision Pro, well, all these products that exist, they're significantly inferior to Apple today. And the tech that they've got there is mind-boggling, whether it is, the immersive experience that you've got, whether it is the eyesight that they've developed, where, the fact that you need to be able to see the human-computer interaction components that they've thought about, the controllers that they've thought about, which is, the new input model using just your fingers and your eyes. all of that stuff, a lot of these things require, as I said, work across the stack, but a significant amount of AI is built into these things. So Apple is constantly building AI into its tools. It just doesn't talk about it. And I think, sometimes analysts think that, they're falling behind, but I really, for a company that has basically displaced Intel completely from the chart of being the leading semiconductor company, I think saying that they don't know what they're doing is, I think, a little bit far-fetched, right? But they have a more of a consumer product-oriented, service-oriented focus. So they want that to speak and not the technology. Technology is a means to an end, and they're focused on the end. And I think a lot of other companies get caught up in the means because it seems to help with the stock price in the interim.
It kind of reminds me of when there was that interview with Bezos way back when the interviewer was like, "Are you guys a tech company or a retail company?" They're like, "It doesn't matter. We're a customer focused company." It feels like analysts are like, "Are you an AI company?" No. I guess I know this will be kind of a tough question to answer because there's a lot. But what do you think are Apple's biggest competitive advantages? And then who do they actually compete with?
It's a competitive advantage. I think we can, so Apple, we can say, if you think about moat, Apple you can think of it as a wide moat company, like say an Alphabet or Microsoft, right? In terms of competitive advantages, say number one is brand, right? The brand and the brand affinity is like the brand power is significant. That's one. They've got scale advantages, right? Because think about it this way. For another company to design something like Vision Pro, it's going to be very difficult because, the number of components Vision Pro could share with other lines of Apple devices, right? Same thing with the processor, for example, right? That allows you to amortize costs. It allows you to also use the best things that you have in other parts and not have to buy that or source that or invent that, right? So I think the scale is another immense thing that they've got. And the scale is not just in terms of product scale, but it's in customer scale, in terms of retail footprint scale. Those are this is just built over time. Then I think the other key thing for them is they are a company that control, and very few companies are very good at this. They control the sort of the entire experience and the protocol, or let's call it the technology stack. Right. So whether it is the hardware, the software, and whether it's the chip, the GPU, the CPU, the memory processing, the AI neural engine, that's all inbuilt in-house, right? Significant control on roadmap. So they know what the roadmap is, they decide, and they're in control of their destiny to a large extent. So that actually really helps them. They've got a bit of pricing power, I would say, as well, because of their reach with their customers. And and again, I think this integration, they've got a lock-in effect as well, right? I mean, if I've got an iPad, an iPhone, and this and that, I'm more likely to get a Vision Pro than ever think of getting an Oculus, right? Because, that lock-in effect really, if you've got one device, you're going to probably buy the other devices. I think those sort of things really work in their favor. So those are really their big strengths, I think, as a company. And I think at a higher level, they are very long-term focused. And if you look at other comparable companies at scale, they are very good in terms of managing their R&D spend. So a great example would be Apple could produce Vision Pro. How much money did they really spend on Vision Pro? And just compare how much money Meta has burnt trying to get Oculus and its metaverse going, right? So it's just sometimes it's not just about how much money you throw, but it's about how you manage it. So they are very capital conscious as a business. Right. And, this, I think, is an important thing that it often is not thought about.
Yeah. And I totally agree with that. I think we don't have to talk about the metaverse stuff with Meta, but because that would be a whole nother 30-minute conversation and there's a lot of uncertainty there. But I do want to maybe talk about who their competitors are, because it seems like Android versus Apple, it's very separate. It's almost like it's very symbiotic. I mean, Google and Apple have a very strong relationship. Are there really competitors out there? Because, I mean, some could argue maybe even like WhatsApp is kind of a competitor to iMessage and stuff like that. I mean, what do you see as maybe the competitive threats to Apple today?
So look, I think they compete. So I think they compete with different players in different areas, right? And there's a lot of competition. It's like, so whether, if you think about, for example, if you take the Mac line, that competes with a whole bunch of Windows and other, these Chrome OS based stuff, right? So there's strong competition there. If you think about wearables, they've mostly won that battle, but there is still, the various Android Wear and stuff, Samsung Wear, and Google is doing something there. So there's competition there. There's competition in these sort of things, right? Trillions of companies make these things. There's of course Android versus iPhone competition. So there's Samsung, there's HTC in terms of devices. So I think there's tons of competition. Then in terms of services, there's a lot of competition, right? So there's, if you think about buy now, pay later, for example, they've launched this, they're late to launch. There's so much competition. Almost all services have significant competitors in them. So there's a lot of competition. But I think Apple's upside really is that for Apple's customers, providing a set of services and devices that they would like to use is their upside, really, right? Within their own ecosystem, and slowly growing their ecosystem is what they're really trying to do. But there's a lot of competition, and in consumer electronics, there's a lot of competition always. So I think there's a lot of competition, but there's not, what you're referring to, there's no direct competition, but it's not a monopoly like search, right? It's not a monopoly like search. And search is really a monopoly. There's if you think about it, there's just a monopoly. But there isn't a monopoly here in that sense. They have a strong hold on customers.
Right. Yeah. And we'll get to I have a follow-up in the risk section about any potential antitrust legislation. So we will hit that, any listeners who are interested about that. But first, I want to talk about valuation, just general thoughts on that. I know it's trading at the trailing multiples at a premium level. So I guess, what are your thoughts on what sort of returns, forward returns Apple investors should expect, especially at a market cap of, are we at 3 trillion again? I know the buyback made it so it's not, it's a little bit lower.
No, we're not. I think we're about 2.8 trillion. So the question is, are you cool for me to share a sheet and we can talk through a sheet?
I'll let you, okay, you should be able to share. Go ahead.
Okay, so let me see. This might be a different way of share screen. Okay. All right. Can you see my screen now?
Perfect.
Yes.
Okay. So this is a rough model, and this is actually, maybe this is a way to think about valuation. This is what I call a reverse DCF. So I'm not trying to build a discounted cash flow model. What I'm doing is I'm using a simple discounted cash flow model to understand what is baked into the share price today, right? Which will answer sort of your question as to what's the upside. And it's all qualitative stuff. I'm not trying to make a quantitative judgment. So the inputs are really, what's Apple's free cash flow trailing last 12 months, close to $100 billion. What's this net cash position? You can do it based on total cash and total debt, but it's really what matters is what's the net cash position, because you're going to use that to calculate the enterprise value, total shares out. And it's just a simple model where you just are trying to predict what is the free cash flow growth rate baked in for the first decade, assuming a certain terminal rate and a certain discount rate. Okay, so I've always fixed for these sort of models the discount rate between 9 and 11%, and the logic behind that is between 9 and 10% is what the S&P 500 returns on over the long term. So I just use that as the discount rate. Now, this is not got people would use the WACC and things like that. I just try to simplify things, because my theory with all of these things is all models are wrong, because they're by definition they're models and they have lots of assumptions. But what I'm trying to do is, some models are useful. I'm just trying to get some useful insight here. Right. So I fixed my discount rate at 10%. I generally fix my terminal rate at 3 or 4%. So I've given Apple a 4% terminal rate. And then based on today's share price, I'm just reverse solving for the growth rate of free cash flow. Which would allow the current share price to be the fair value today, intrinsic value today. So that works out to be actually 11%, which is not nothing. Right, you'd expect the free cash flow to grow. It's basically the market. One way to think is the market is saying that free cash flow should at least grow at 11% over the next decade, which means in a 10 years from now, roughly $280 billion of free cash flow, just 2.5 times, 2.7 times of where it is today. Right, possibly doable, So that's one way of, to cross-check that, if Apple can grow its services business at a decent clip, it should be able to do it. Another way to think about this is to get free cash flow to grow at, say, 10%, 11%, you probably need your revenue to grow at a high single digits. Mid to high single digit revenue growth should be enough. Right? But that's basically saying that Apple is basically fairly valued. Right? It's not market beating in that sense, right? But I think the one thing that is not considered in this reverse DCF is the total number of shares out, which is up here, right? Because I did not change it. I'm not changing it. I'm keeping it fixed. But we know that what is Apple doing? It's free cash flow. When it generates $100 billion of free cash flow, it basically is just buying back its shares. Which means we can almost be certain that if Apple is on the trajectory to generate these billions of dollars of free cash flow that we have got here on the spreadsheet, it's going to be used to reduce the number of shares that it owns that are outstanding. Which means if you think about from that point of view and you think about capital allocation strategy, then I think you get to the point of, well, it's potentially quite market beating from here on, as long as they can keep generating the free cash flow, because the share count is just going to decrease. Like Apple's share count is down by 40% over the last decade or so. It won't be down that much in the next decade, but even if it's down, like say 20%, that's going to be enough to deliver market beating returns, right? And then there's upside in terms of if the revenue grows faster or things change, then you can get right. So yeah, it's in other words, the price is not. I wouldn't say the price today is something that it's like an obvious buy. I think the only time that I felt it was an obvious buy was in 2016, 2017, 2018, when people were pricing it for debt, and it was trading at like a 10% free cash flow yield. Today it's trading at roughly a 3.5% or 3% free cash flow yield. Still significantly better than many of the other companies which trail at 1% free cash flow yield, or other companies that do not generate any free cash flow and have no plans, or looks like have no plans of generating free cash flow. So, I think it's a fair deal, and I think there's a good chance of market beating returns from here, but it's not the same thing as buying, at $150 or $120, $130, it's like, okay, it makes sense to, so when the panic button hits, and you always get this, when the panic button hits, companies like Apple are good ones to buy, because, the chances are that nothing has significantly changed for these businesses.
And so just to kind of rehash what you just said there, because it might be sometimes hard. We go through this all the time where we talk a bunch of numbers and then listeners might be like, all right, I'm lost. So you're saying that the market is basically forecasting or expecting 11% free cash flow growth. However, with Apple plowing so much of that into buybacks, you could potentially get, they're not factoring that in. So you could potentially get higher returns. At 11% growth. Like you said, that isn't nothing. I mean, 11% growth, that's a good amount, especially for a business that's generating, $400 billion in sales every year, or somewhere around that. I guess my question to you is, if you weren't a shareholder for the last 10 years, would you be buying today? Or would you just, I know it's a little more difficult
yeah.
when you have kind of maybe not the emotional connection, but you've been with them for so long.
Yeah, so I think that's the ownership bias coming into play. So as I said, I think that something like 10-11% of free cash flow growth is baked into the share price, assuming no buybacks. That I think, and I think it's free cash flow. The key thing is that the free cash flow can grow at a faster rate than the revenue. So the revenue actual growth doesn't have to be very high. So I think the amount of revenue growth that's baked in is actually not that high. I think high single digits is probably, somewhere between 7-8% is what's baked in. So if they can surprise on the upside, then there's a lot of surprise potential there. You can put it this way. I think the portfolio construction is such a personal thing. I almost hold Apple as an anchor core position, right? And if I didn't have it, I would still have it. Because it's a nice, to have a company that generates so much free cash flow, those companies tend to get a higher multiple just because they generate so much money, right? So I would own it. I would not personally be looking to, have a substantial increase in position, right? But that said, the contradictory thing here is, and this is where psychology comes into play. My Apple position is pretty large already. Like it's probably around 8%, 9%. Maybe I should be looking actually to downsize it a bit, or maybe run covered calls on it. But I'm not doing anything on it, largely because the other thing I've found over time is it's just so difficult to precisely value things. Right. We just know that, it's roughly around by this measure, I think there's a decent chance of being market beating, and we just leave it to the company to execute. And, I guess the thresholds are not that high, and I just leave it at that. And then they see what happens. Right. And it has consistently overperformed its peer group. But yeah, there's been a lot of PE expansion and so on. So yeah, I would not be rushing into buy at this, but I would, as a core, I love having it as a core. It just gives me comfort. It doesn't move that much relative to some of the other stuff that I own that can drop by like 60%. So it is just a core position in my holding. But yeah, this is a hard one, and I think it depends really on individuals and what they're trying to do with their portfolios.
Yeah, and it's funny because Brett and I spend a lot of time doing valuation work on a lot of the companies we own, but that first qualitative assessment you had in 2012, where you're like, okay, the customers are avid for any product that comes out, and the business is just executing and has a history of executing incredibly well, seem to be really the two most important things for that investment. So, I mean, I think sometimes it just, like you said, the buy and hold approach, a lot of it, I would say probably 90% of it comes down to the qualitative assessments. I guess one more question from me, and then Brett has a few. Warren Buffett is the largest outside shareholder, I believe, other than Vanguard and BlackRock. So the largest, Berkshire is the largest individual, I guess, shareholder. They, I think, bought in around kind of that 2016, 2017 timeframe. Do you think he's had any impact on Apple's capital allocation strategy?
I don't think so, because the buybacks started in Tim Cook's era, so buybacks were already happening. Well, they were well and truly on its way, and so I don't think so. I don't think, it's nice to have a cornerstone holder in Buffett or Berkshire, but at the same time, Berkshire actually, in my opinion, would be like, there's a lot of variability and unknowns with that company right now, right? I mean, both Charlie Munger and Buffett are very old, right? And we don't know what happens in the succession. We don't know what the successor is going to do with the portfolios. We don't know how much more active trading they're going to bring and things like that. There's just a lot of stuff. We can say that it's going to be more of the same, but we just don't know. But I don't think, it has, there have been temporary bumps in the PE and things like, oh, Buffett bought, so it must be good, must be value. But I don't think there's been any big changes in their allocation, like capital allocation strategy. And when I say capital allocation, I mean broadly in terms of the share buybacks, putting that money for investing in different projects. They're very, very measured in, their R&D is very measured relative to other companies. Here's this fun fact that people don't know, where almost all the big tech report non-GAAP numbers. Apple always reports GAAP numbers. Has reported all those GAAP numbers. So you need to kind of adjust the Apple's P of whatever is actually the GAAP P. Whereas the other people's, the P's that we see is all, the diluted, normalized, blah, blah P. Their SBC is also very modest. So a lot of these things for Apple are quite unique to Apple. There are actually very few companies that are like this. In terms of, So, and I think going back to 2012, 2013, I think the biggest thing that at that point was that post Steve Jobs, we did not know what was, there was a lot of uncertainty as to, did we lost an innovator, what's going to happen? But as I like to tell people is Tim Cook is the swan song of Steve Jobs. Steve Jobs did two things before dying. One was put Tim Cook in charge, and the other was to tell people, do not think like Steve Jobs. And I guess the third thing was he built the Apple campus. But those were the things that he did for the longevity of the company. right? And I think Tim Cook is a very underrated leader. So I guess if you, a longer term risk is who is the next leader for Apple. That's very unclear, right? And that I think is a risk because you want a leader like Tim Cook who can navigate politics and the relationship with customers and so on really nicely.
Yeah. And speaking of risk, I want to hit that before we close out. No company is riskless. There's one that's big, at least in my mind, and then maybe you disagree. And there's one that's smaller that could have a potential impact, but I still think, wouldn't be detrimental. Is the first one is just any exposure to China, both from a consumer standpoint and a supply chain standpoint, specifically with Taiwan Semiconductor. And then second, could antitrust legislation or any sort of that type of thing really have a big financial impact? So curious your thoughts on either of those situations.
Yeah, so I have broad thoughts on the China thing. So I think, here's the thing, the way I look at China. So yes, there are some tech companies that don't have exposure to China, but I can't imagine a scenario in the world where there is a huge conflict between, let's say the West and China, because that impacts every consumer company, that impacts every consumer, that impacts all of us in so many different ways, right? So it's. And I don't think there is a good, knowing, there's no way to position yourself in this, I want to be China safe, so-called, right? And the reason for that is, then you won't be wearing shoes, shirts, you won't get maybe some of your cereals and food items, you won't get your cars, and all of those things. Cost of living is going to go up. There could be nuclear war, all of those sort of things, right? So I think there's no. I'm as an optimist, I believe that things will work out and things should work out because there's just too much for everyone to lose in a situation where things get ugly with China, right? That doesn't mean that they wouldn't compete and they would be using, things like, your legislative policies and investment decisions to, tackle and block each other. That's only to be expected. And I think that's going to continue to happen. But so that's one. So I actually de-weight China because on the risk, largely because you want to be playing and you want to be engaging with everyone to have an impact. So non-engagement is actually not useful. So I would expect that a company should try to actually be in China, and it's the second largest market to be in many ways, right? So if you just give up on that market, then you've given up on opportunity for revenue growth and opportunity for influencing customers. So that's one. Antitrust. Okay, so I look at antitrust as the antitrust issues. I think there's a lot of nuance there. The problem I see with antitrust regulation is not revenue. That's not the problem. That they mandate, because Apple could take a smaller cut of its digital goods, or Apple could take a smaller cut of payments. None of those things are actually that material to Apple. I think what is really material is if regulators basically require things like side loading, it's going to make I think regulators have a way, and regulators are really poor decision makers because, I think we should just let the capital markets make the decision, because I'm just, I just don't like the heavy-handed regulators deciding what cables are going to be put into my computer, what app, how should an app market run. There's competition, there's app market opportunities, and people can decide whether they want, if they don't like Apple's ecosystem, they can go to Android, right? It's not like this, it's insurmountable difficulty. Each company makes it easy to switch from each other. But I think that the problem is that if regulators regulate such that the integrity of the App Store is destroyed, that has an impact on experience. Now, I think companies in general, tech companies are able to think 3 steps ahead, whereas regulators today are thinking about stuff today and they probably get replaced, bureaucrats get replaced by other people. So it could be that Apple itself disrupts the App Store business model enough that, so there's the point, case in point would be that the App Store is not that relevant for things like wearables, right? Maybe the App Store is not going to be that relevant for things like a Vision Pro. And, App Store is not that relevant even for things like Mac, right? So, maybe it doesn't matter for iPhone. Maybe it matters. I don't know. But I think there is that risk that it can make the experience bad or worse.
All right. Let's wrap things up. You already mentioned, some of the risks kind of play into this as well. But just as we close things out, anything else that you're looking at as sort of a pre-mortem, as sort of, okay, what would happen 10 years from now from an investment in Apple to go poorly?
Yeah, so I think the biggest thing in my mind, the biggest risk that people don't talk about is who's Tim Cook's replacement? Who is the next person in line? So it clearly, and I think that's important because it potentially isn't Jeff Williams, who is the CEO today, who's an operations guy. He does actually manage the HCI design team. But that's after Johnny Ive left, he's sort of been managing the design team. But he's almost the same age as Cook, right? So it's really not clear to me who is sort of the next. And the only person I can think who is young enough, but has deep Apple strength, bench strength and experience is Craig Federighi. I can't pronounce that name, but he's probably the youngest of the lot, who has been, has worked with Steve Jobs, has worked with Tim Cook, is deeply embedded into Apple. So he seems like a guy who could take over. But that's, I think, the big question is the next leader of Apple going to be able to navigate Apple? Because Apple is going to be a much bigger company. It's a much bigger company today than, say, 10 years ago, potentially, and they would like to make it even bigger in another decade. So you'd have to navigate it a lot. So I think it's really the leadership would matter. And those are, again, unknown unknowns. You can pick someone. They might be likable, but they might make a lot of bad decisions. But at the same time, the way I look at this is hopefully the DNA of the company is so solid that, this company operates in a different way, has, very flat hierarchies. It's not a very hierarchical company, works across design systems and across teams very nicely. So hopefully the genes of the company are strong enough that the new leader is able to work in and, bring their own, mark to the company like Tim Cook has over time. So I'm cautiously always optimistic. I try to be optimistic about any company I hold because otherwise it's very difficult to hold through difficult times.
Yeah, I think it's probably fair to say this is one of the best businesses in the world. I think that's probably reflected in the market cap. But I think you're right. There's definitely got to be a lot of talent, a deep bench across the executive suite there. That is all the questions we have, though, unless Brett has any more. He's giving me the thumbs up. So that is going to do it. I guess for listeners that haven't heard of you before or want to follow more of your work, what's the best place to find you?
Oh, look, I'm a lead advisor at 7 Investing. So, you can find stuff that I write about on 7investing.com. If you're into reading research papers, and I've written a lot of technical research papers, you can go to Google Scholar and find my work from my past life. But I'm assuming a lot of your readers are not going to do that. But yes, I dabble a bit in research, still do that. But I write actively about companies that are mostly in the enterprise software, consumer electronics, electric vehicle space. sort of thing. There's a small set of companies that I follow. I follow them closely, but I cover them. Most of them I talk about on 7 Investing. So, and on Twitter, I always have something to say about Twitter. It might not be always the best thing to say, but there's something to say on Twitter, and it's a nice way to connect with people and chat about things and just exchange ideas.
All right. Well, that is going to do it. We want to remind our listeners that Brett and I are not financial advisors. Anything we say or discuss here on Chit Chat Money is not formal advice or recommendation. We are, however, general partners at Arch Capital, so clients may have positions in the securities discussed in this podcast. Thank you all for listening. Thank you, Anirban, for coming on the show again, and we'll see you all next time.